I love paying little to no taxes, and that is one of the biggest reasons why I choose to contribute to a traditional IRA and a traditional 401k over a Roth version. And today in this video, I'm going to give you 5 complete reasons why I choose traditional over Roth. Because the traditional investment advice for pretty much everyone is, contribute to a Roth if you can. Contribute to the Roth because you don't know what the future is going to be like, and the money that is in there is your money. It's all 100% tax-free once it's in there. And that could be good advice for some people, maybe even better advice for the general population. But when you're pursuing financial independence, you need to optimize a lot more things in your life. And part of optimization is reducing your taxes. And I'm going to give you 5 reasons why I think that traditional IRA is just better for most people that are trying to build a net worth, and better for most people that are trying to achieve financial independence. And the very first one that I want to start with is, pretty obvious but very important, is that you get tax savings today. By contributing to a traditional IRA, you therefore reduce your taxable income. Granted that you don't fall into those upper income categories where you get phased out. But let's just assume, you're pretty average income or pretty median income, and you contribute to an IRA. Well, that IRA contributions, that traditional IRA contribution, becomes a tax deduction or an adjustment to your income. So if you make $50,000 and you contribute $5,000 to a traditional IRA, it reduces your taxable income by that $5,000 to $45,000. And so that is $5,000 of income that you don't pay any income taxes on right now. And not paying taxes today is really important because that allows you to take those tax savings and invest it as well, and that will grow over time. And over the long run, that money can add up to big over time. Let's say you're doing this 10 years in a row while you're trying to achieve financial independence. Well, all of those extra tax savings, as long as you take advantage of those tax savings and also put those into investments, those are going to help significantly grow your net worth. It is kind of like getting a guaranteed return. If you're in, let's say, the 22% tax bracket, the marginal 22% tax bracket, and you can contribute to a traditional account to reduce your taxable income, well, every dollar that you contributed, you're basically saving 22 cents on a dollar. So that extra 22 cents is something that you're going to get back rather than pay in taxes. So you can contribute that extra 22 cents to another account, and it can just compound and compound like that. And you can control those tax savings today. And what you can control today is something that I think you should focus on, especially if you're trying to optimize your life. So going after that guaranteed return is huge. Now let me put up a chart really quick for you so you can see what I am talking about. So as you can see on this chart, I have traditional on the left and Roth on the right. And here's an example. If you have $100,000 in income, and this is for married filing jointly, by the way. If you have $100,000 of income and you contribute $12,000 to either account, a Roth or a traditional, look what happens when you do traditional versus Roth. Your adjusted gross income on the traditional side gets reduced all the way down to $49,000. Now that's if you were maxing out your 401k and your IRAs for both spouses. So that's $49,000 of a tax deduction that you get off of that $100,000 of income. Whereas if you were doing Roth accounts, you don't get that deduction, and therefore your adjusted gross income is the same as your gross income in this example. So having $49,000 of adjusted gross income is very powerful compared to having $100,000, because your marginal tax rate in that $49,000 of income is only 12%, while your marginal tax rate on that $100,000 is 22%. Now look at the difference in tax that you pay. Basically, you are taxed at $19,750 less at 22%, and at 12% you are taxed $31,250 less in the traditional accounts. Whereas when you convert that into actual amount of tax paid, in the Roth account you're paying $3,750 more in tax at 12% and $4,345 more in tax, which is at 22%. I hope that makes sense to you because it made sense to me when I made it. But basically, you are saving a total of $8,095 in tax just by contributing to the traditional accounts rather than the Roth accounts. So that is tax savings that you realize this year. While at the same time, since you contributed to the traditional accounts, you actually qualify for a saver's credit of the maximum amount, which is $4,000 for a couple married filing jointly. And so your real tax savings, when you are contributing to these traditional accounts, making $100,000, your real tax savings is $12,000 $12,095. Let me also change the screen really quick for you just to show that Savers credit, what I'm talking about, just really quick. So as you can see on that Savers credit chart, if you are married filing jointly and your adjusted gross income is between $42,501 and $65,000, then 10% of your contribution is how much of a credit you qualify for. And if you take 10% of $12,000 plus $3,900, you're gonna get that maximum amount of credit, which is $4,000. So just really quick, what that chart really explained is just by contributing to traditional instead of Roth, with a married couple that makes $100,000 a year combined, just by contributing to traditional over Roth, they save $12,095 in taxes because they chose traditional. And $12,095 is a big deal on its own, but that brings me to point number 2 on why I choose traditional. And that is the compounded savings of that tax deduction or of those tax savings. So if I took that extra $12,095 that I saved and I just invested that as well, that can become something so much bigger. So I have a chart for you as well about compounded interest. And so as you can see, if I put that $12,095 in there and it grows at 8%, in 40 years, look at how much it becomes. Look at how compound growth works. So over that 40-year period, $12,000 becomes $262,000. And that's amazing. And that is just from 1 year of tax savings because of those traditional accounts. Now imagine if you did that 10 years in a row. You would be very, very wealthy by just contributing to those traditional accounts because you made those tax savings and because those tax savings were able to compound and grow even more. And you're paying extra money to the federal government in the form of taxes rather than having that extra money that could potentially grow even more in your investment accounts. So that's a really big deal. And another really big deal is number 3. And number 3 is I can't control the future. So right now I can control what I put into my accounts. I can control that I put into traditional rather than Roth, and that could save me that $12,000. But I can't control the future of how taxes are going to be structured, in the future. I can't control what the income tax rate is going to be in the future. So that is a big reason why a lot of people advocate, purely just going with the Roth, and I don't think that's always the answer. I think actually, especially for most people that are trying to build their net worth, quickly, I think that the traditional route is better. And that's because I don't know what the future holds. Yes, that is true. Maybe taxes will go up, maybe it'll go down. I can't really say. But what I can control is right now. So I don't know what future tax rates are going to be, but I can control my withdrawals in the future up to a certain point. Especially if you're saving for financial independence and you have a good buffer zone within your spending. Let's say your baseline spending is only $30,000 per year, and that covers your basics like housing and food and transportation and maybe some other small basics and bills. Let's say you can live off of that $30,000, but you also have another extra $10,000 built into that. So you're actually spending $40,000 per year, but that $10,000 is kind of just discretionary, for fun, maybe just traveling and things like that. So if you have that buffer, you can control your withdrawals in the future. You know that you can control your withdrawals. You can't control the future tax rates, but you can control your withdrawals up to a certain point. So I want to focus on what can I control personally. And right now I can control reducing my taxable income and reducing the amount of taxes that I pay, but I cannot control the future tax rates. So that's one reason why I also choose traditional over Roth in most circumstances. And tax optimization is a really big part of financial independence, and especially about this channel, about On Cash Flow. And if you're enjoying this particular video, and please give me that like, give me that thumbs up. It really helps me out. I really do appreciate it. And at the same time, if you are interested in optimizing your life, optimizing your finances, optimizing your taxes, then please, I invite you to subscribe to the channel, because every single week I am putting out information on personal finance, and I know that there's something that I can help you with. But getting back to number 4, I kind of already spoiled it when I was talking about number 3, is what I can control now. So I can control that I can take the deduction now. I can make that choice to put money into the traditional account, take that tax deduction, and take that tax savings. I can control that. I can control that I can get the retirement savers credit, or just the savers credit. So up to a certain point, if I can reduce my taxable income to meet that requirement, then I can get that savers credit. And that is just an extra tax credit, which basically eliminates even more of my tax liability. But that's not possible with the Roth in a lot of circumstances, because the Roth doesn't reduce your adjusted gross income. And by contributing to those traditional accounts, you are getting more money to reduce your adjusted gross income. So by reducing your adjusted gross income, you can make yourself get into that bracket of the saver's credit and then get even more taken off your taxes. And you just can't do that with a Roth IRA. And another thing that I can control is I can just shovel as much money as I want to, into my accounts. That is something that I can control now. So worry about what you can control now. That's number 4. And don't worry so much about what you can't control in the future. And that was number 3. But moving on to number 5, this one is a little bit more advanced when it comes to, the financial independence and getting money into those Roth accounts. And that is known as the Roth IRA ladder. So I'm not going to go too far into detail on the Roth IRA ladder, but I do want to explain it, basically in simple concepts for pretty much anyone to understand. The Roth IRA ladder is basically where you convert traditional account money into Roth account money. So for example, you'll be taking traditional IRA money and you'll be rolling over it or converting it into Roth IRA money. And when you do that, those conversions are treated as contributions. So if I take $20,000 out of my traditional IRA and then I go and I deposit that into my Roth IRA, I am basically contributing $20,000 to my Roth IRA at that time. And I am able to do more than the standard contribution to the IRA because it's kind of like a rollover, it's a conversion, not necessarily just a contribution, but it is treated as a contribution after that money is in there for at least 5 years. And that is what's known as seasoning. So for example, after I put that $20,000 from the traditional into the Roth, after 5 years, that money becomes seasoned, and then I can actually withdraw that $20,000 just as if it was a contribution to the Roth IRA. And that is really powerful because what that allows you to do is that it allows you to, once you become financially independent, that allows you to take money, convert it from your traditional account into your Roth account, pay less in taxes on it because that is a taxable event. You are no longer working and therefore you no longer have a higher income to pay taxes on. So the amount that you do roll over is going to be a taxable event. So that's why you do smaller increments throughout many years while you are financially independent. And I'm definitely not the origin of the Roth IRA ladder. This is not my original idea, but it's something that I plan to do in my own future and something that I think is really powerful for the financial independence community overall. And so I do want to give credit to where I actually learned the Roth IRA ladder, and that is the Mad Finance. So also known as Brandon, he has a really popular blog, and I'm actually going to put up a graphic on the screen really quick made by him. And as you can see in that graphic, it pretty much explains what I was trying to explain a lot better. So you contribute your pre-tax retirement accounts during your career to reduce your taxes. So you put money into those traditional accounts while you are working. And then once you retire, you then transfer everything into your traditional IRA, kind of just so you can kind of consolidate all of your funds. So once you do that, you then convert a portion of your traditional IRA to your Roth IRA. You'll pay taxes on the amount you convert, but you don't have to convert it all at once. You can convert over several different years. And then after 5 years, the money that you converted can then be withdrawn, basically tax and penalty free because it is in the Roth IRA. So by following that Roth IRA ladder, you can potentially get money in tax-free and get it out at a very low tax rate and possibly even tax-free depending on how much you roll over per year. So that is probably the most important reason why I chose traditional over Roth during my working career. And if you're on the path to financial independence, it is something that you should consider as well. And another thing that you need to consider is you need to consider watching this video that I made about how to achieve financial independence in 10 years because it is the blueprint, it is the outline to achieve financial independence that will pretty much apply to anyone. And even if you are already seasoned in how to achieve financial independence, I know that you can get a lot of good stuff out of that video. So please make sure you watch that video as well because that is full of good information on achieving financial independence and becoming a master of your own cash flow. Thank you so much for watching this video. I'm Zach from OnCashflow.com and I hope to see you next time.